Okay, very good morning. Anthony here to give you the rundown for Monday, the 23rd of October. Hope everyone is well and had a good weekend. Obviously, quite a few pieces of news that have come out over the weekend. So what I'm going to try and do in this briefing is talk over a couple of those major points and then have a look at some of the highlights that we're looking at for the week ahead, which of course includes the latest ECB interest rate decision. So, getting down to business and starting off with the charts this morning, and what are we looking at? One of the biggest kind of immediate moves overnight has been that of Japan, where we've seen, really, let me just show you this firstly. This is the Nikkei 225, so the main stock index in Japan, and as you can see, the level which we've had here defined by the green kind of shaded bar on the far right is the last 15 days. This 15 consecutive day advance in the Nikkei is now a record streak that we've seen, and this comes of course after the Japanese election which occurred over the weekend, where PM Abe has, with his coalition partner, achieved a 2/3 majority in parliament. So as you can see down here by the green, a resounding win here. 312 seats out of the 465 seats available for the LDP and Komeito coalition, securing this supermajority needed to revise the constitution. So in summary, what does this mean for Japan? Well, it means much of the same, really. I guess continuity is one thing that we've learnt from politics in the last kind of 12 to 18 months. It's kind of met and greeted fairly well with relief by the financial markets in general. And what you've had then, Japanese stocks, 15th consecutive day of gains, that's a record. If we're looking at the Japanese yen, a little weaker, dollar yen gapping up from overnight when it reopened trade following these results. And this is what it basically means, a fresh mandate then for Abenomics and a chance to pursue his personal priority, revising Japan's post-war constitution. So in terms of, from a policy point of view, well, really unlike some of the Western central banks in Japan, it's more a case of you can expect QE for the foreseeable future. And so hence the weaker yen and the firmer Nikkei that was seen in the overnight session. But looking elsewhere in what we've had, the dollar is a little bit firmer this morning. The dollar index is trading up about 0.2%, so both major pairs you can see here in the top left, a little heavy. One thing, if I just bring over into shot at the bottom chart here, so this is the IBEX, the CFD for the IBEX, and the reason why I just want to show you this is because I want to look at that in relation as well to the Euro's movement. So you can see here in the Euro-dollar pair, since Europe have come into the market really 7 AM this morning, and when the cash markets open, the IBEX under pressure. So as you can imagine, there has been developments over the weekend in Spain, and this has been here. The Catalan separatists plot a response to Spain's shock and awe. So what's happened? Well, over the weekend, the Spanish PM Rajoy formally invoked the constitutional power from Article 155 and has outlined a series of measures that he's going to look to implement. So in terms of timing going forward, party leaders in the Catalan parliament are scheduled to meet at 10:30 AM to discuss the timing and agenda for the chamber's kind of next decision making, essentially. So I guess this is Spanish time, so be looking out for that in about an hour from now. Having a look at the measures that have been taken, it's pretty far reaching, hence the negative response in the market, because Spain's chief prosecutor said that basically the Catalan president, if he calls independence formally, he would face as much as 30 years in jail, and could be signalled that he would be arrested immediately. Some of the other measures that Rajoy had pushed forward from the weekend, dissolving the Catalan parliament with plans to call new regional elections within 6 months, assuming control of the regional police force. This was everything that we had spoken about over the course of the last week or two in regards to this being the kind of more aggressive move from the federal government to take control of that region. And so that materializing has created some negativity, but I'd say if you're looking actually at the euro and the price movement, we've basically weakened about 20-25 pips in the move since Europe's come in just to price in the latest situation. However, irrespective of the fact the IBEX is slightly underperforming, the move by no means is huge. So if I just transition, so you can see here, this is the euro this morning and the IBEX. And again, I think a lot of this has been priced in to a degree from the developments that we're seeing with the kind of the talk was ratcheting up at the back end of last week. So this could be in some way to be expected. Euro dollar then finding a bit of support just down at that low that we're seeing at the reopening and commencement of trade overnight in Sunday evening, London time. Looking at the euro, just while we're on the chart, obviously this is a daily continuation now, and we'll talk about the ECB shortly, but obviously it's a big week because of the ECB are tipped to start unveiling their details towards the beginning of 2018. What are they going to do with their quantitative easing program in terms of reducing its firepower? And so it'd be interesting to see how the market reacts to that. And if they do disappoint, and let's say disappoint in terms of what they've been setting us up for, and let's say they don't deliver something quite as hawkish as some might expect, then there's a fairly significant level here on the downside around basically the 117 handle, because that starts to encompass then a couple of critical points for the euro over a longer time frame, that being the kind of midsummer 2015, a repeat of 2016, and then the kind of support point, which again for 2017 summer, but also more recently at the beginning of this month, created some support in the price action. So if that starts to get threatened, that could be quite an interesting level to keep an eye on, and certainly in the context of what generally from a Fed policy point of view, they're sticking to the script for the December hike. If we are to get a re-emergence of dollar strength, Trump at the weekend talking up the prospects of still looking to deliver this corporate tax kind of movement by year end, which I think is highly unlikely. But if that does come to fruition, then certainly dollar strength could help be a catalyst for that move to occur. Sticking with the US then, a couple of points to discuss here. And this is just, first of all, let's bring the Dow into shot. And obviously last week, pretty phenomenal week really, if we look at it in its entirety. Really defined by this point here, which we thought at the time was a pretty big move. I'm pleased that a lot of the traders here on the career program took full advantage of that increased bout of volatility that we had, and it seemingly was the breach of 23,000. It was the following day where the market looked to, if anything, just book some profit. There was a little bit of an upping in the discrepancy between the language of the Catalan president and that of PM Rajoy at the time, which created some nervousness in addition to a couple of weak European earnings. But then came the powerful recovery, the technical break back above that previous resistance point, helped by the US Congress passing that budget resolution, and then fueling this really big push, and then we've just pushed even higher again, all the way up to see out the end of last week, and we sit around those levels at the moment. I was looking at some stats though about the S&P this morning that are probably worth sharing with you, just to put these equity moves in the US into a bit of context. And so if you're looking at the S&P 500, the index has now gone 33 consecutive sessions without a 0.5% daily decline, which is the longest streak since 1995. The index average daily range on an absolute basis so far this year has been 0.3%, the smallest since 1965. It's quite incredible when you start looking at these statistics, and one would argue that as the economic cycle continues, at some point this streak, you would think, needs to end. And the kind of frightening prospect would be that the longer these stats start to stack up, then the bigger that kind of pullback when it does occur could be. And so looking at this graphically, The longest streak ever without a 3% correction is where we're at the moment in regards to the S&P. So as we've continued to edge higher to these record levels, you can see here, I mean, you're going back to really 95, the last time we were at this point. So in terms of equity markets in the US and how we stand right now, there's little really to detract from the point that I don't really see a reason to see this stopping anytime soon. And so the preference would still be, at least at this point, for picking levels to get long the market again in terms of the week as a whole, barring anything unexpected that does occur. Just looking at the S&P here, this last push higher that we've had, you can see here we've got above 2,500. Really, the pursuit of 2,600 has taken absolutely no time at all. It's really a month pretty much of price action, and we're only about 30 points away from there at the moment. So could that be seen this week? Sure, it definitely could be. But again, the preference would be for this week to still be wanting to get long this market, because continuing that trend looks to be the more prudent approach when it comes to US equities, at least for the time being. Speaking of the US, there has been a few more murmurs about the Fed chair. Obviously, we're getting close towards a decision from Donald Trump on who is he gonna put forward, and we still continue to have a bit of discrepancy between what Trump is saying and what his advisors and close kind of senior officials are telling us. And so President Trump has signaled Janet Yellen is still in the race for the next Fed chair, noting most people say it's down to two people, i.e. that being Taylor and Powell, but Trump said, "I've met with Janet Yellen and I really like her," was quote his words. One point here is that, well, really two things. One thing at the weekend, if you were going to talk your way out of a job, I think Janet Yellen did a pretty good job at that at the weekend, because she basically gave a speech where she defended the use of quantitative easing and said, actually, we could use it again in future if we needed to. And that certainly is the polar opposite of what some of the other people like VP Mike Pence and Treasury Secretary Mnuchin are pushing, which is basically John Taylor, which is completely the other end of the spectrum, where if you're applying his kind of economic view of the world, then interest rates should be way higher than what they currently are at the moment. Jerome Powell being lesser so, more a continuity approach of current existing Fed policy. But I would say this is certainly something to keep an eye on this week, because any snap kind of news agency rumours or source reports about who this could be, again, the way to be read is, if it was Yellen, that would be, I would say, well, as per this chart is indicating, Jerome Powell and Yellen is kind of net neutral. Gary Cohn, I'd say, is the most dovish and probably by far the least likely to become the next Fed chair, and these two chaps on the right, Taylor and Walsh, being the most hawkish. So this is how I'd perceive it if that we were to get updates on that. Okay, moving over, another chart to quickly have a look at is crude oil. This morning we are seeing fractionally higher, we're up around 36 cents at the moment in WTI crude. We are just above, well, really the high print that we had around the close from the end of last week, which is around 52.24. Looking at oil on a slightly longer time frame, that's while my chart populates here. And on the upside, the next level of significance being the end of September high that was seen up just shy of the $53 handle, 52.86 to be watched. Any push on beyond there, and really we start talking about the 2017 highs. If we push up towards the kind of mid-April level, that was up circa 54, and then the year-to-date highs that were seen up around the 55 handle. So OPEC continued to do a pretty good job of talking up the market. You know, last week, well, really the last 2 weeks, we've heard plenty of conversation from the likes of Saudi and non-OPEC names like Russia talking about they're committed to doing more beyond the point of the expiration of the existing deal at the end of Q1 of next year. Well, the last thing that I read at the weekend was about compliance. One of the main things is, if we just drop down to the bottom here, compliance to the OPEC-led cuts was 120% last month. I think the prior month to that, as far as I remember from memory, was about 86%. So they've gone from 86% to 120%. As far as I can tell, this is the most compliant that they've been. They have gone over the 100% marker a couple of times since this deal began. Obviously, it's been 10 months now in the pipeline, or in the works. But according to the Joint Ministerial Monitoring Committee, 120% now. So maybe this just explains a little bit of the market's reaction to just being long the market this morning, because this, as far as I've read, came out over the weekend. Other things are OPEC and its allies reiterating that all options are open to rebalance the market. So again, these record levels of compliance, in addition to US drillers reduced the rig count for a third week to the lowest since the summer. So again, this is obviously, if you're looking at the rig count, which is the blue bars on this specific chart, you can see here from where we were really July time, in the middle of the summer, was when we peaked. So if we were looking at US output, which had been on a tear, basically continuing to climb at fairly significant rates, have we now started to hit a bit of a plateau, given that rig counts have gradually started to fade slightly here more recently. So US rigs have fallen for the third week in a row. This was the data which came out from Baker Hughes, obviously on a Friday. So a couple of these factors keeping oil fairly well bid. I guess the only thing on the short term would be movement in the dollar to impede further gains on the upside. As I said, the dollar index specifically right now is up marginally about 0.15%. And then technically the 53 handle is kind of the next big level, which would be that high from about a month ago that would be keeping an eye on. Okay, so having a look at the session for today, what have we got? And actually for a Monday, as per usual, it's relatively quiet. There is one omission I can see that they've not put on the calendar here, and that is Theresa May is going to be speaking today in Parliament. This could be very interesting, and I think it will be worth tuning in for. I would assume that going off normal times, this will be around midday, but she is basically reporting back to Parliament what she achieved or what the developments were from the Brexit negotiations from the EU summit. So it's going to be interesting to see what she's got to say, with really not a lot's been achieved, and how does she stand up against the opposition, questioning her and her ability to deliver Brexit for the best interest of the country. So that might be worth watching for the pound. There was also some commentary at the weekend. I'm sure if you were reading UK national press, you probably saw this. Labour have threatened to back Tory rebels on the Brexit bill, so opposition could support changes to legislation sought by backbench Conservatives. So I'm sure this will be brought up when they discuss things later on. So Labour has identified 12 amendments backed by rebel Conservative MPs to the government's flagship Brexit bill that it will support if ministers reject the opposition party's demands for changes to the legislation. So just to give you a quick summary, these are some of the main things that they're pushing for. Basically, they want giving Parliament the final say on the Brexit deal, backing a 2-year transitional period after the UK leaves the EU at the end of Article 50, softening the Henry VIII powers, and various other points as well that they'll want amended. Now, this obviously is, I wouldn't say a deal breaker for what's going on with this situation with Brexit and for the leadership of Theresa May, but it certainly does detract from the bigger thing that needs to obviously get done, which is that with having some progression in these discussions with Europe, with which, as we've said, there's been none so far. So more complication domestically for Theresa May. She's obviously back against the wall today as well, having to explain herself to Parliament when really there was not a lot of headway made last week, so could be something interesting to just keep an eye on for the pound as we go through the session. This is looking at the week as a whole, because I guess if you want to look at structuring your kind of activity or where your kind of allocation of interest might come in terms of scheduled events that could create the most volatility for market prices. So Tuesday could be interesting because we get the various service manufacturing PMI numbers. We also, don't forget, earnings season is fully underway now, both sides of the pond. So if I'm to look at the US, for example, there's 186 of the 500 S&P companies reporting this week. So if I was to look at some of the highlights from the US just quickly before we look at the economic data, we got AT&T, McDonald's, General Motors on Tuesday. Typically, if you remember, earnings season, we don't tend to get much on the Monday. It's kind of a hump in the middle of the week of where the bulk of the earnings reports come. It's the same case in the UK and Europe. So AT&T, McDonald's, GM on Tuesday of some of the bigger names, Boeing, Coca-Cola on Wednesday. You get the tech giants, Amazon and Alphabet on Thursday, and then you get the energy majors, Exxon and Chevron on Friday. From a UK and European perspective, really you've got Lloyds on Wednesday, Barclays, so the UK banking sector Wednesday and Thursday. Then you also get UBS and Total on Friday from the earnings side of things. Otherwise, looking at economic data, Wednesday, German IFO, obviously always an important number to monitor for forward-looking sentiment. UK GDP, this is going to be a key metric going forward as well, is about how much does this slow. Now the expectation is that just given the ramification of what these inflationary conditions have had on our economy and the consumer, is to what degree is the economy in the UK slowing at the moment. So this will be a key point of interest for the week. US durable goods, new home sales, Bank of Canada interest rate decision obviously comes after their most recent rate decision, where they not wholly surprised the markets but went against slightly the consensus thinking, and they, if you remember, they opted to hike interest rates at the time. So it's now the next round of their rate decisions. That'll be on Wednesday. On Thursday then is the big one in terms of if you're trading European assets, because this is when we'll hear Mario Draghi take the stage, and this is one of the most important ones in a while, because this is when we are looking out for what is Mario going to do with the bond buying program. So as you can see here, a rather perplexed looking Draghi as he tries to manage market expectation and what will be a very difficult thing to deliver, because this is really unprecedented. The tightening of the QE process is uncharted territory for Draghi and his European colleagues. So even a modest narrowing of the bond buying program may do long-term euro damage. That's what the FT are writing this morning. Now, looking at what some of the banks are saying, Deutsche Bank pretty much in line, I think, with what the general market consensus is. They expect a cut in the purchase in terms of the ECB's QE program at the start of 2018 from 60 billion per month to 30 billion, and for this to be confirmed for 9 months. So this is the new kind of shape of what the ECB have been telling us, rather than a 6-month extension with a smaller staggered approach. They're going for a larger drop over an extended period. Another hawkish signal to look out for, Deutsche note, is a signal could be to mention of an explicit end date for purchases. Obviously, if they say, okay, we're going to do this until this definitive point in time, again, the more definitive they are with the strategy, I'd say the more hawkish that is. The more open-ended, the more loosely the terms are surrounding what they're going to do with it in the future, the more probably dovish that would be perceived. But we're going to talk about this a lot more, I'm sure, as we go forward into the week. One thing I would say is that as we go through the next coming days, I would say probably Tuesday afternoon, Wednesday would be the most opportune time for ECB sources. It would not surprise me at all if we had at least one newswire source giving a bit of a scoop and an inside feel for what the ECB are going to do, just for them to bed into market expectation exactly what their intentions are, in order to just kind of control some of the market reaction over what could be a fairly volatile press conference and meeting that the ECB will need to deliver this Thursday. And then finally, just wrapping up on Friday, you've got a couple of US data points: GDP, core PCE. Michigan is the final reading. Baker Hughes rig count, as we said, could be interesting now given the consecutive weekly drops that we've seen. And then that's it. So this is in your inbox if you want to have a look, but I'm going to leave it at that, just coming up to 9 o'clock, so let you get on with things. But overall, you've had continuity in Japan, supermajority for Abe's coalition, which means short term just a further pursuit of Abenomics, so more quantitative easing coming out of the Bank of Japan seemed likely. You've had 155 of the Constitution invoked in Spain, so be looking out for more commentary later on this morning from what the latest is with that. So some slight negativity in the Euro and the IBEX, but nothing massive because a lot of this has been priced in. And then equity markets overall still remaining fairly buoyant, up around these record levels, and with the Nikkei a 15 consecutive streak gain, that's a record, so minor risk on, evident with the dollar a little firmer, gold lower than, down in the yellow metal about $4. Okay, have a good session guys, and a good week ahead. Thank you.